Time to introduce Neeraj Gambhir, Managing Director, Head Fixed Income India at Nomura Capital, who also joins in on the show. Neeraj, to start off with, let's talk about the impact you think the policy move had. Do you also agree with most of the brokerages that in the medium term it's a positive and it will correct the imbalances in the economy?
Yeah, so I think that's the call and that's the stance that we have, that in the medium term it's a good policy and it's a good move to focus back on inflation. I think a lot of the policy space was getting hogged by the currency movements and the short-term sort of reaction to the currency movements. I think the policy has kind of brought back the focus to the growth inflation dynamics, and clearly given the fact that inflation has been sort of running a little higher than what the policymakers had anticipated, and there is an expectation that inflation will continue to be a bit higher than what has been forecasted earlier through the year. This policy clearly brings back the inflation fighting credentials of the central bank, and which is clearly something which is quite positive for the economy.
Neeraj, the second half borrowing calendar is expected to be announced later in the day or perhaps sometime during the week. So are you expecting an increase in the numbers for the second half of the year? Mind you, the government had already planned to raise about 58% of the entire borrowing target for the year in the first half. So do you expect the second half to be higher? Will they increase the target for the second half?
Well, I think there is a certain amount of fiscal deficit number that has been already planned, and there is a very strong commitment given by the finance minister that that's a red line, and he would not like to cross it. We've already seen some kind of austerity measures being announced to make sure that the government spending stays within the budgeted amount. So given all of that, it is not expected that we will see an increase in the overall government borrowing program per se as compared to the budget. So whatever is the residual that needs to be done would be announced. There could be some tweaking in the borrowing program with regard to the maturity spectrum. There could be some shift towards the shorter dated maturities to accommodate for the fact that banks will be looking for assets to deploy the FCNRB borrowings that they raise. But beyond that, I'm not anticipating a substantial change in the borrowing program per se.
And as far as the weighted average cost of these borrowings is concerned, do you expect a substantial hike in the weighted average cost, about 50 basis points, or will it be even higher? Because if you look at how the rates have moved from April to now, it's been much more than 100 basis points.
Well, I think the fact that the interest rates in the economy have gone up as a result of the monetary policy actions, in the months of July, and also the fact that there has been a subsequent repo rate increase, and there are chances of further repo rate increases as we, go through the rest of the year, means that the interest rates in the economy across the board have gone up. The borrowing cost has gone up for the government as well as the private sector borrowers. So this should start reflecting in the government's fiscal numbers going forward. I don't think the government, in a sense, the government bonds have actually taken the most of the brunt, especially at the front end of the curve, where even the treasury bill yields have actually gone up in the past. So all of this would start reflecting in the overall government's borrowing cost. So I do indeed expect that the borrowing cost for the government will go up through the rest of this year.
One more question that the governor spoke about. He spoke about the Reserve Bank of India toying with, two kinds of retail CPI-linked bonds. What kind of bonds could they be, and would that not increase the cost of borrowing to the government not just by 100 or 150 basis points, but by substantially more? Because we are talking about CPIs at close to double digit. So then, what kind of CPI index bonds can the RBI hope to launch?
Well, I think the overall size of the borrowings, which is currently linked to these, indices, whether it is WPI or CPI, is not very large. It's still a very small component of overall government's borrowing program. We have some idea of the kind of spreads that the market is asking for with respect to the WPI as an index. We haven't seen any borrowing program happen so far which is linked to CPI. So the details are a little bit sketchy at this point in time, so it's not very clear to me as to what kind of spreads are we talking about. Even if we talk about, say, 200 basis points or 300 basis points spread to the CPI index per se, then the borrowing cost will indeed be quite high compared to where the government is borrowing overall compared to the inflation index bonds. Now, you could consider this as a cost that the government is willing to pay to wean away the economy from real assets such as gold, which has had quite a devastating impact on the current account deficit. So yes, the cost is likely to be higher. It can be substantially higher than where the current borrowings are, but that could be considered as a sort of a subsidy or a cost being given to make sure that there is an attempt towards more investments going into the financial instruments as against the real assets.
Yes, you're right on that the government had set aside a relatively small portion, 20,000 crores was the amount that they'd mentioned. But at the time of, raising money through the inflation index bonds linked to WPI, they had set aside a very small portion for retail investors. Bulk of it actually went to institutional investors, which at one level was slightly strange. But now that you're going to link it to CPI, do you anticipate that the entire issue will be open to retail investors?
As I said, the details are a little bit sketchy at this point in time, and what is the modus operandi they are planning at this point in time. But it could potentially be something along the lines of, the small savings instruments, which is probably more open for the retail investors. It's on tap. It's available through the banks. It's available through the market intermediaries, and not necessarily follow a wholesale sort of issuance process, which is currently done for the government bond market. So I would think that it makes more sense to do it in the form of a pure retail instrument which is distributed through the banking system, which is more like an addition to the already existing small saving instruments that we have, rather than a pure competition to the wholesale borrowing program.
I'm just going a step back and wondering what happens to fund flows, foreign fund flows into the Indian debt markets, because a lot was spoken about that because the tapering has been pushed by 3 months or 6 months, as the case may be, and because the flight of capital initially happened because of the very fears itself, there might be some fund flow that could come into the domestic debt markets. Do you anticipate that or not quite?
Well, I think the fund flow has certainly picked up and it's stabilized a lot. I think the entire sentiment around rupee has turned around a little bit, I think in line with what's happened with the other emerging market currencies. Now going forward, the fund flow towards emerging market economies, especially the debt flows, will again be quite dependent upon how the entire US policy sort of plays out and what happens to the emerging market complex of currencies. I do feel that current government bond yields and corporate bond yields in India are quite attractive. However, that attractiveness is sort of marred by the fact that there is a pressure on the currency. So if the currency does stabilize, then given the levels where the yields are currently, I think I would expect that the fund flow to kind of pick up substantially. Also, there is this talk about India getting included in some of the major, local market indices, and if that were to happen, I think that would be a big game changer for the fund flows into the emerging market economies like India. And I do feel that while there is a lot of gap between what is required for a country to be included in these indices and currently where we are, if the government were to take the right kind of proactive steps around this, and the bonds were to be included in the indices, there would be a substantial positive flow over a period of time.
So you're going back to the question that you posed to you about the bond fund and also about the differential between US Treasury and our own bond yields. Now that US T-bill yields have fallen and ours have risen a little bit, do you think the Indian market again looks attractive to overseas debt flows, number one? Number two, the cost of inclusion in a bond fund index, does that increase the vulnerability of the Indian economy in the medium to long term?
Well, I have let me answer your second question first, which is basically that does it increase the vulnerability of the economy? I think the capital flows, whether they come in equities or whether they come in, fixed income space, are by their very nature are volatile. Even if you say that these flows come into equities, but they are sort of not permanent in nature, they might be more sticky than debt flows, but they are certainly not permanent in nature. So I do feel that we tend to overemphasize the volatility in the debt flows. The reality is that once you sort of get linked to the larger bond indices to which a large amount of money is getting indexed, and that indexation sort of helps provide some kind of permanence to those flows, I think the stickiness of the flows actually improves quite substantially. The second aspect of it in terms of attractiveness, yes, certainly I do feel that bond yields are quite attractive, but you have to look at the bond yields in the context of the stability of the currency, the potential of depreciation in the currency, and also in the context of the local inflation. So I think while at the nominal level the bond yields are quite attractive, the investors are forever sort of looking at the relative performance of the economy and the relative sort of inflation differentials and the currency stability. Once we achieve a certain level of currency stability, and once we do see some kind of stability to the inflation, I do feel at the current levels the bond markets are quite attractive.
Yeah. Maybe we should go back to your question about the difference between flows into equity and debt. A person who is investing in the equity market, he's basically taking a view of the Indian economy's future potential as a growing economy, whereas the person who's investing in the debt market is looking at it purely as a play on the differential in the yields. Would you agree? So that makes a debt flow guy more short-term rather than the equity guy?
Well, I think it's a matter of perspective, and I think within the equity and debt space you will have all kinds of players. Within equity space as well you will have players who will be interested in short-term movements in the equity markets, and within the debt space you have investors who are actually interested in longer-term performance of the country. So I do feel that you have all kinds of investors in both the space, both the fixed income as well as an equity side. The point is that as Indian economy grows, as Indian economy matures, and as Indian economy integrates with the rest of the world on account of trade and on account of external borrowings, further opening up of debt markets is only going to happen, and it's important that it happens so that we have sort of a better sort of capital flow which comes into the economy. Bear in mind that India does not need only the equity flows, but it also requires a significant amount of debt capital to come in to ensure that the real sector is financed with the right kind of debt equity ratios.